Let's get Stu on. Hey, one piece? Yeah. We can actually go and start. Good morning. Welcome to the BYU Marriott Real Estate Webinar Series. My name is Barrett Slade, Professor of Finance and the host of today's webinar. We invite those of you who have questions during the presentation to click on the Q&A button at the bottom of your screen and type those in, and then we'll get to those as we go along and as time permits. So today we have with us Mr. Brandon Blaser, founder and president of BCG Holdings. Brandon, welcome. It's good to have you here and on campus.
It's good to be here, Brandon.
And we're excited to learn more about you and your journey in real estate, and especially about opportunity zones. So thanks for coming. Take it away.
Well, fantastic. Well, I appreciate the opportunity. It's always fun to come back to campus. It's been a long time, and I've been fortunate since I've moved back to Utah to have opportunities to participate with the growing real estate program here at BYU. So first off, thank you. There was not these opportunities or this amount of attention on real estate when I was coming through school. And I think it's just a fantastic opportunity for the students to be able, and us alumni that are in the business, to be able to connect and network with each other. But I guess just by way of introduction, I am born and bred Utah. I guess let me go to the slides. They always tell a prettier picture than looking at me. So really, one more here. There we go. So born and raised in Utah. At least when I left Utah after graduating BYU, I spent 20 years of my career outside of Utah and decided to come back in 2018. When I decided to come back, there's a lot of things went behind that decision, but I was actually a little bit reluctant after being in Boston, San Francisco, and Dallas in these professional worlds. I thought the reaction of a lot of my peers would be, Utah, where is Utah? The old Fletch movie, that doesn't date me too much. That was the reaction to what Utah was. But it was the exact opposite. Utah had definitely fallen on the radar of everybody in the institutional real estate world, and really felt like we were getting in front of a moment and an inflection point of where Utah was maturing from what it had been traditionally to what it really has become as one of the top tier, second tier, but highest growth, highest job potential, one of the best economies and one of the best places to invest in real estate in the country. And I felt fortunate that I was able to get in front of a lot of that. And honestly, a lot of what my time and success has been here in Utah is because of just the success of Utah over this past time period. But a little bit more background, I guess, I am jumping back to a slide if it can connect. Sorry. Like a lot of people who find themselves in real estate, I was born into real estate. It's in the blood. Family business growing up was the original affordable housing, mobile homes. But at on mobile home park, I like to say, it was a great motivator to when you set a double wide in Winnemucca, Nevada, you tend to study and you want to find a different and better employment opportunity. But there was satisfaction I saw my father have, and we had, when you were able to provide housing to families. And real estate just was something I always was interested in. However, out of BYU, I first went into strategy consulting and then into venture capital. I was in venture capital in Palo Alto, March of 2000, right during the dot-com boom and bust, and realized that even though that was like the hot and fantastic, highly desirable industry to be in at that moment, it wasn't where my passion was. And I think in any industry, you're going to have ups, you're going to have downs. You really have to find out what you're passionate about. So I went back to business school, was able to go to Harvard, went in 2003 to 05, really to transition into real estate. Again, being from Utah, you've got to embrace the full Utah-ness of my childhood. I was one of 8 kids. I do have some proof that I did have hair, but my family did the wonderful thing of naming us all the same initials. Bert, Brittany, Brandon, Brady, Ben, Brett, Bobby, Joe, Bridget, you can understand why I left Utah for 20 years. But, you know, really, it's been fun coming back and being around family. I did graduate BYU in 99 in accounting. I left demanding a refund because I was unmarried. Did meet my wife a couple years after that. And you can see the Blaser women are much better looking than Blaser men. I've got 5 daughters and 1 son, so 1 shoulder to cry on. And I think I was telling you before, I really appreciate the opportunities to come to BYU and teach, and even moments like this, because at home with 5 daughters, I don't really have an opportunity to talk much where people will actually listen to me. So this is a unique opportunity and one I like to take advantage of. Jumping past that, really, I think what you had talked about and where I think might be of interest that we haven't talked about in other webinars is opportunity zones. Opportunity zone legislation is really a unique mechanism that came about in 2018. It was a bipartisan law passed in the tax reform bill that allows real estate, well, really allows any type of mobilization of gains that were really unlocked within the US economy to be deployed in areas that otherwise would have lacked investment opportunities. So it's jump to probably a lot more detail in here, so we can talk just high level on this. And a lot of people know about opportunity zones. It's not new, but it is a little unique if you're not familiar with it. I was basically barely came home. I wanted to be a ski bum for a year. I'm not that great of a skier, and the snow was the lowest it's been in 40 years. So when opportunity zone legislation passed, I heard about it through a good friend, went home and read the 33 pages of legislation. And I thought it was going to be a game changer, because what it allows is a mobilization and unlocking of gains where people could be defer their taxes, get a discount on their taxes, and even avoid taxes on the profits of their investments that they make in underserved communities. So here's the different mechanisms that you have to do in order to make it work. You have to substantial improvement. You have to double your basis, effectively excluding your value of land. So you can't just buy a property and just hope it appreciates. You can't just try to get in front of it and be a slumlord. You have to really purposely invest in that community, or you have to change its use. If it's an old warehouse, you need to take it to office or multifamily, vice versa. And so it really was a brilliant piece of legislation that opened up the opportunity for the federal government to incentivize investors and trillions of dollars of money to be deployed into underserved communities across the country. The other beautiful thing about it, which was, I think, very special, is they left it up to the states, the local government, to decide what of their 20% of their low-income census tracts they could designate as opportunity zones. So while it's a federal program, states matched it, but states got to select where they were doing. Different states that did, some did better than others in understanding it and deploying and designating zones that really could drive capital infusement. And Salt Lake City and Utah in particular has done one of the best jobs in the country. And so that really was where I saw, after being 20 years in the business, really 15 years with a private equity company in Dallas, I saw the opportunity of long-term capital, tax motivated, to invest in communities that needed to be changed. And coming back home and doing this in my backyard, that's the type of investment and capital I wanted to be affiliated with. Having come from the capital side for 15 years, really there was a choice. Do you get in front of the product, or do you get in front of the capital? Having been on the money side, I saw if you control the product, when there's an infusion of capital, you got to control your life, your destiny, and the opportunity set. So I decided to get in front of the capital, or get in front of the product and control. So with opportunity zone, here's a little bit of the mechanisms, and we can go into detail here if you want. But I apologize, I was jumping in and you were going to ask me a question.
No, that's great. No, continue.
Well, on the this is just a little bit more about how the mechanism of opportunity zones work. And if there's any questions on this, I think we can probably leave that to Q&A. Don't want to go in too much technical detail here, but again, it's the deferral, the reduction, and potential when you invest in the money, even though you've just deferred the original gain till 2026, that investment of $1 million at the end of a 10-year hold, if you hold it for 10 years, so motivate you to be a long-term minded real estate investor versus short-term flip, you avoid any taxes on that appreciation of the asset. So truly, I saw a lot of people do really, really silly things to avoid paying taxes. This I thought was a really brilliant piece of legislation that would motivate people to invest in the right way, and partnered with the right people could really make a change in communities and in areas, especially here in Salt Lake City. So I felt fortunate to be right place, right time in order to get in front of this, because really the economics of it, it's is probably way more detail. The sum of it really is 400 basis point swing in an op zone versus non-op zone investment, all the same dynamics being the same. So it drives down the cost of capital, and it's really impactful to investors and allows you to probably fund projects that would probably have a harder time, or areas that would have a harder time attracting capital than otherwise would be. So that's the overview of opportunity zones. And again, hopefully in the Q&A, if there's anything people want to know more detail about that. But want to talk a little bit and just kind of go an overview of what we've done at BCG in our opportunity investments. And this is, if anyone's familiar, has ties to Salt Lake City, this may speak a little bit to them and be familiar with it. So when I came back to Salt Lake City, it wasn't the market I left 20 years ago. There's so many great things, City Creek, 9th and 9th, all these neighborhoods and parks have really elevated themselves. The other university to the north of us here, being in the Pac-12, really changed a lot of the dynamics. However, when you enter into the city, Salt Lake City, this slide shows 6 South, the main entry point into the city. It hadn't changed at all. It was old, dilapidated warehouses, a lot of vacant buildings. I like to say, heroin needles, homelessness, and graffiti. And that was really what blighted the entire entrance to this city that really has been growing and was attracting institutional capital. But yet this has been just an overlooked area that had been a hub for the industrial area of Salt Lake City before. And so this is really where I focused a majority of my time when I first came back to Salt Lake City. A lot of it is granary or granary district related. This is, if you're not familiar with Salt Lake City, this is really where it all sits, right at the entry point into Salt Lake City. So again, access, visibility, all the fundamentals of retail were really strong here. I also had the benefit of having worked in Nashville, Denver, Charlotte, Austin, other markets that had seen a renaissance of their old industrial area, and Salt Lake City was just a little bit earlier on that curve. So get in front of capital flow, pattern recognition of other markets that had done this. I felt fortunate to be just right place, right time again. And Collective BCG, we've assembled about 45 acres in and around the granary district, which is in total, 100 to 150, depending on how you define it. So we are definitely making a big bet on red, but part of it is strategic, because the hit on Salt Lake City and Utah, no offense to Brigham Young, big massive blocks and big wide streets does not make an urban walkable environment. Salt Lake City's blocks are 4 to 9 times the average size of other blocks in neighborhoods and markets that I've been in, and people are familiar with: New York, New Orleans, Portland, Denver. And so that's really the challenge Salt Lake has had in drawing kind of urban revitalization, but that's also the opportunity. So if you are able to assemble larger parcels like the Church Can and City Creek, you can break these blocks up, you can create a new neighborhood, you can do cross streets, cross alley access, and really take 4 corners in a 10-acre block and make 8 corners, 12 corners, and really create a neighborhood. And that's really what the opportunity and strategy that we at BCG have been pursuing since the inception, and utilizing the opportunities on investment in order to do that. Because building neighborhoods are a long-term type process. It's not get in and out in 3 years. It really is something that you've got to have real long-term, patient, and forward-thinking capital on. So here's a little bit of assemblage of the 45 acres we have. There's obviously many other folks that are in and around this area, but it does also create that network effect. You're putting in 500 million into one area, owning across the street and capturing that value and controlling that value is something that we think will create long-term value for our investors and frankly, the neighborhood. Create enough of that connectivity piece that we can really move the needle on what that area is, versus if we were just doing one-off buildings here and there. So and the nice thing is too, one of the big things that we have at BCG is we really don't want to buy any businesses or any properties where we're displacing local businesses. We really go after places that either the businesses are closing down or have closed down, they're dilapidated or vacant. Okay. We want to support small local businesses. So this is an example of one of the first projects that I assembled when I first moved back here. Is old industrial area. This is really on the cross streets of 5th South and 6th South, 3rd and 4th West. Really, literally the first intersection coming into Salt Lake City. This is that corner. We've successfully assembled 13 acres there. Actually went out for 35 million of equity, thinking it's in the growth path. We'd qualify for the opportunity zone and build it up over time. Fortunately, our investor was much smarter than I was, and it was with Bridge Investment Group, and they said, no, you need to do this all at once. You need 90 million of equity. Well, never to be, challenged without coming back. I slept on it. We ran some numbers, and my risk profile, we did not want to count on that much leverage. So we came back and said 135, and it's your deal. So 135 million later, you never know unless you ask.
Right.
We've been able to take what was empty warehouses and blighted neighborhood, really with very few, if any, tenants, beyond month to month type people, and turn into a brand new neighborhood. Part of our ethos is, adaptive reuse. Any of the historical buildings we've reused and repurposed. So 150,000 square feet of our commercial space is adaptive reuse space. We'll have another 150,000 square feet of new ground up build on commercial space with 580 apartments. So this will be at full build out, a little over 400 million of total project costs. We've started to deliver the multifamily units now, and by the end of this year, this entire neighborhood will be complete. It's really exciting to see. My office is actually in the top corner in the little red building there. It actually, this is what it was when we bought it, and this is what it looks like now. So being able to preserve this building and office there and watch this project come to life here in my backyard has been.
So how long from the start to when you reach stabilized occupancy?
So we closed on the property. We put it all under contract in late 18, closed in 2019. And so now we will be through all of the phases except two parcels that we kind of put on second phase when COVID hit. And with current finance market too, we've kept kind of a secondary harvest in two parcels. Just neighborhoods don't all get built all at once. So these two pieces are a little bit of a secondary harvest. So we will be complete with all of this by the end of this year. So it's a 4-5 year, depending on how you want to measure it, full build out of 13 acres.
That's mixed use.
Very much mixed use. We closed on this pre-COVID. Let's see. We closed on it pre-COVID, and we've actually, our retail on post districts almost completely spoken for. We've actually, when office is supposedly dead, we've signed between this and other projects that we'll go through. We've signed a little over 500,000 square feet of office leases since COVID began, which is just a testament, I think, to the growth and strength of Salt Lake City, as well as kind of the appeal of this adaptive reuse, old historic product that has more of a character, more soul. And it's not, more of the sterile high-rise building. This is something that is fairly unique in the product type.
So how is that being received with more and more firms appear to be going to a hybrid remote or some sort of remote working? Are you getting some nervousness by those who sign those leases? Or they're all in, things going well, they're occupying?
Everything's going really well. I mean, the product is a bit different. We a little bit more flexible on lease term. We sign 1, 3, 5 year lease term, our average lease, but we've got, Traeger's corporate headquarters, we're doing the rebuild for, and that's a 17-year lease. Okay. So our average lease term is in the 4 to 5 year across the portfolio. Mm-hmm. We try to create these moments where the amenities are not just within the building, but they're in the neighborhood or they're shared. And so people can take less space than maybe they previously had or in other spaces. Okay. So price-wise on a per square foot, we're really competitive with downtown rates, but I think the utilization they get and the draw to be in these kind of up and coming areas and the ease and convenience of the location and parking, I think it really appeals to those groups. And we haven't seen that same softness. I think, we're always going to be prepared for that. We always underwrite for that. And that's, again, why we didn't go highly levered when we had this much commercial space to it. But office has been doing better than I think you would have expected, having started this right in the beginning of COVID and even in downturn now. And retail is actually doing far better than I would have hoped. We're beating underwriting across the board on our retail. So really, the next project, once you do the 13 acres and you're putting, 300 million to work in this project, what's going to happen next door? There's some old historical silos right next that came available during COVID. Put that under contract, still not knowing exactly sure what we want to do, but I didn't want someone to come in and just scrape it and rebuild some of the same old product. We wanted to keep the uniqueness of the neighborhood and character and leverage the investment we had and protect the investment we had while creating value across the neighborhood. So now we've assembled another 8.5 acres there that will be a mix of adaptive reuse and new ground up build. And this block, which is what we call the silo block, I think is going to be really unique from an impact perspective. This is with the main lead investor on this is Catalyst Investment Group, which is an impact-oriented fund. They really measure us, our performance, not only just on economic returns, but on social and community returns. This block has the pieces we don't own are state supportive housing. So in one block, you will have people transitioning from homelessness, joblessness, and then we're doing 180 affordable units between 20 to 60% of AMI. And so you've got people who are just climbing up the economic curve all the way to market rate units. And so really in one city block, you're going to have, everybody from the entire, it's a mixed, not only mixed use, but it's a mixed income neighborhood, which I think that's where people can start to associate, they can start to affiliate, and they can grow versus, low income being segmented off in one neighborhood versus the other. So we found in study after study, when you can mix the income within the neighborhoods, those of the lower income strata are able to elevate themselves and generationally be able to pull themselves up much further, much faster. So we're really proud of being able to create kind of this unique block and retail center while still preserving some of the cool historic aspects that I think will be a monument exit to Salt Lake City.
So the silos remain.
So silos, half of the silos do have to come down. Economically, we just cannot preserve them, but we are keeping the main stack that really will sit as a monument coming in and out of Salt Lake City. How we underwrite it is, we'd love to be able to go in there, build units, do something. But right now we've just underwritten so we can keep them. If anything can pencil within them, over time, now it doesn't, but maybe in the future it does, we're preserving that right. But at a minimum, it's going to be lighted. It's going to be a backdrop. It's going to be a monument. It's going to be signage. It's going to be something unique that defines that exit coming out of Salt Lake City. Because it's the last thing as you leave on 500 South, which is really the main 90% of the traffic coming out of our capital city in Utah comes out on this road.
Yeah, well,
and so
it
this will be a
provides so
fun thing to
much
see.
character to the whole development as well. Right.
And that's a fun thing in doing the neighborhood development, because you can be more thoughtful in each of the individual pieces. If all I owned was the silo project and just that silo building on 1 acre, it wouldn't make economic sense to keep them. When you own the entirety of the neighborhood, you can justify and make economic sense of doing that more placemaking moments and uniqueness, because it creates value for a larger pieces. So that's the part of the strategy we have. This is one of the projects, really, this is one I'm not a managing partner of, but it's one of the first projects I led the capitalization on. We started this actually pre-op zone. We recapped it into the opportunity zone. Great partners with Catalyst again on this. And this is that small business incubation that we have tenants anywhere from 500 square feet to 60,000 square feet. We've drawn in biotech companies, robotics companies, and a real mix of companies going into an old silver factory that dates back to the early 1900s, repurposed in a way that my partners have done a fabulous job in the design element of it. And we're 92% occupied, and we launched the Thursday after Salt Lake shut down for COVID. And so it's really becoming an anchor for the neighborhood, and you can see the kind of uniqueness of the asset. And happy to go into kind of why that office is being much more successful than I think traditional offices at this time.
Let me ask you why you're talking about that. I'm curious on the environmental contamination that you dealt with at all. Did you encounter some struggles or unexpected?
It's
issues?
Always something you've got to worry about here. It's funny, environmental issues and title issues. Ironically, we've had so many title issues on these older areas because over time, somebody forgot a little stamp size, a 5x10 square in the middle of the building wasn't in the title records. And so you've got to do a lot of the cleanup. Environmentally, we've been really, I think, fortunate. We do a very thorough study on everything. We've got minor cleanup issues on most of the projects, very little on this industry project in particular. Because it had been corporate owned in its past history. And so previous contamination had been cleaned up prior to our ownership. We do have one site that we are going through a full environmental cleanup. It's a 9-acre parcel we call Granary Square, but the contamination is really limited to about a half an acre. And so we're going through that entire process right now. The nice thing about opportunity zones is any of the money spent on environmental remediation qualifies towards that doubling of basis or change of use. So we get credit against our tax incentives for any environmental remediation, which again, I think is a thoughtful part of the legislation in order to enable development in these areas.
I'm assuming in your underwriting, you anticipated some risk in this regard.
Well,
So,
we do all that through our due diligence, all the underwriting. We get enough time to study and go through all the environmental testing. We won't close on anything unless we've got a firm handle on what it is and what the cost is. And frankly, you always add about 20% to that. Whatever you think it's going to cost you, it's going to cost you 20% more. And I always like to say, no matter what you underwrite day one, you're wrong. But over 10 years, you're placing a value on what you can create for the neighborhood and value for investors. And the story will play out. We're still in the first and second inning. This is again another example of what we're able to do with opportunity zones. I know a lot of groups are investing in one-off buildings. They may not have the same ethos that myself and Catalyst has, but here's two old historic buildings we bought very early on in the opportunity zone because we knew and had seen values rise dramatically in these revitalized areas. In other markets, in Denver, you could buy stuff at $35 a land foot. Now it's $225 land foot. In Salt Lake, I was buying at $35, $50 land foot. Now it's $150 to $200 land foot. So I bought these two buildings here without really a full business plan, but knowing the basis was low enough that I had to buy then in order to ever preserve these buildings. Because now if I had to pay $150 to $200 a foot, you couldn't justify keeping these buildings. But for us, the character, the soul, the spirit of that neighborhood would be lost if you weren't able to preserve these. Another thing I'd point out here too, that's really helpful. You'd see in the office design here behind what we call the Pickle building is a mass timber hybrid. The beauty of looking at 10-year money and 10-year value is you can think about development and sustainability, I think, in a much different way. Sustainability is really hard to pencil on a 3 to 5 year hold. When you're 7, 8, 10 years, then the turnover costs, the operational costs, those other things for long-term owners, as well as thinking about what buyers are going to command and demand in 10 years takes on a different meaning. So we are able to push, I think, on the sustainability front much further within the opportunity zone than we would otherwise.
Get an interesting mix of tenants also that want those types of buildings. It creates
it doesn't always show up in the spreadsheet, but if you look at all the anecdotes on like mass timber and those environmental forward pieces, the lease up is much faster. It's hard to sometimes convince equity that there's a reason for it, but a lot more people are coming on board with it, and you're seeing a lot more of those precedents happening right now. We had hoped to do the first mass timber building in Salt Lake City. We still might get Salt Lake City. Gardner Group is doing a great mass timber project down in Draper. So within Utah, they're first out of the gate. But we hope to see it, really promulgate a lot more, throughout the valley. This is the Granary Square. Can't show you many more images in here. We are working with a large tenant, but this is a continuation of the Pickle and Hyde, 9 acres of old industrial area that there's really only one building that we're able to keep, and it will be more of a ground up, higher density, but neighborhood planned mass development on this west side. So that I think is really kind of the overview of opportunity zones and kind of what the projects that we've been doing. So I don't know if you have any.
Well, I know I've got a few questions, and I think let me just check as far as our audience here. Let's go ahead. We do have on this mix of low income to higher income communities. Is this happening in other states you had lived? This is, just I guess answer that question.
Yeah, a number of other states that I've lived in, some of it's legislated, like in Boston, every apartment complex, you have to have a certain number of units that are affordable. And it's a bit more forced versus opted into. And so sometimes I think when you're a reluctant developer pushing affordability, it takes on a different meaning than when you do it from a purpose-built standpoint. There are a lot of people that are focused on doing affordability. We personally, BCG, we mandate 20-25% of our housing needs to be affordable across our portfolio. Every project, and every equity partner may not dictate it, but we want just, maybe it's the mobile home manufactured housing roots. But it's also, I think, when you think about value, you need to not just think about value for your investors, but value for the community. And if we don't start fixing some of the affordability issues, if you're only building for the Goldman Sachs employee, one, there's far fewer of those. And two, it creates other societal issues that will diminish the value of the neighborhoods in which we're operating. Right. The fact that the guy that can buy the $100 steak and the guy that can serve the $100 steak And the guy who built the building that the $100 stake is
Okay.
being sold from,
Okay.
all can live within 2-3 blocks of each other, is
That's awesome.
unique.
Yes, it's wonderful. Tell us a little bit about your, the way you approach these investments. You have the cost of capital issue, but for opportunity zones, but do you approach the underwriting, the thought process much differently, or is it very similar?
It's similar in mechanism, but a 10-year hold is definitely changes a few things with it. 10-year hold just anytime you introduce time into an IRR, you're going to diminish that IRR. So you have to think a little bit different on your structure than maybe what a typical private equity shop was. We were very motivated on IRR when I was at the private equity shop down in Dallas. We'd say we could hold for 12 years. When you do the math, if we don't sell in year 3 or by year 5, our incentives are not aligned with a long-term hold. And so we want to be very careful with our partners in an underwriting, not only dropping our cost of capital, but even restructuring how we're measured and performance-based promotes or worked within opportunity zones, because you have that dictated 10-year hold. And folks have been very receptive to that, because the biggest thing is you want to create alignment between the developer and the equity, so you're both marching in the same direction. 10 years also introduces, real estate cycles are usually 7-8 years. So you're going to get hit with something. You don't know when it's going to come. When I started this, did I think global pandemic would happen? No. But on 10-year hold, we didn't underwrite, 65, 70% financing. We underwrote 50 and 55. We wanted to be overcapitalized on the front end through the development, because, we didn't anticipate 30, 40% run up in costs. We didn't anticipate interest rates doubling. We didn't anticipate the pandemic, but we're well capitalized enough from a risk perspective going in on 10-year hold that we can weather those storms and not have to do any short-term value destruction because of kind of a short-term blip of the market.
Right.
And that also in those larger blocks allows us to phase projects a little bit differently. So right now, you can't finance nearly as well as we could 2-3 years ago. Well, on 3, 5, 10-acre blocks, well, instead of building 2 of the units, you build 1. And, you can stage through, monetize what's there while you build through, be a little bit more slow and deliberate while still keeping that long-term value in mind. Because keep in mind, the opportunities on investors, they still pay taxes on any current distributions. They get the depreciation benefit. They're really looking at that exit value.
Right.
That value at the end is where their main tax benefits are. So as long as you align and keep yourself aligned with your equity partners for that long-term value creation, these momentary blips in the market, I think you can weather.
Yeah, excellent.
Can't always anticipate it, but you can be conservative and underwrite around it.
Okay, here's another one that's just come in. Are you concerned about residential multifamily supply coming into Salt Lake? I'm assuming that they're talking about excess supply potentially.
Yes. Well, you mentioned opportunity zones. How does it change underwriting? I would think, owning 45 acres, I was just concerned about the supply that I was putting down. We at full build out could be 3,000 to 4,000 units, and doing all of that at one single time can be problematic. Right. So again, it goes back to probably my private equity days of structuring and alignment. The last project we've closed on 9 acres, we closed all equity. I gave up some of the upside and said, we have no IRR hurdle because we want to go slow. The biggest risk we thought we had at that time was supply and oversupply, where I'm competing and cannibalizing myself. We said, look, let's let the neighborhood come together. Let's do 1 or 2 of these pieces and recycle that capital through over the 10-year period versus just put it all to work in a 2-3-year period. That's the biggest risk in op zones, is if everyone comes in and they all have those time constraints, everything gets built at once. That's not how the best neighborhoods are built. And you will have supply issues there. I'm still bullish on the 10-year horizon for Salt Lake City. I do think you need to be very careful on supply issues for a moment, but that may be the next 18, 24 months, when you plan, underwrite, and structure for really that 10-year value creation, I'm still very, very bullish on Salt Lake City.
Excellent. Is Salt Lake an established institutional market? If not, what is lacking to be a top-tier institutional market?
Salt Lake City is never going to be the top-tier coastal market. However, that's not a bad thing. Top-tier coastal markets, San Francisco, LA, New York, Boston, we're never going to be that size. We're never going to be that scale.
Not a gateway.
We're not a gateway market. Gateway markets will attract foreign capital far easier than Salt Lake City will. Salt Lake City has hit that tipping point of institutional capital. When I first moved back here, I thought, all these peers that I've been working with would think, okay, well, he's off and never interact with him again. I'd go to these national conferences, tell people I was moving back to Salt Lake City, and I felt like the prettiest girl in the ball. I mean, everyone wanted to talk to me. Everyone wanted to invest in Salt Lake City. I get weekly calls from MIT, from Goldman, from Invesco, from all these institutions I had experience in history with, all want to be in Salt Lake. They hear the growth story, they know the growth story, and they want to be part of the growth story. And that growth story is not changing anytime real soon. So the volume's not here yet to make it a gateway market, but the attention is here. We're right on the heels of Austin, we're right on the heels of Denver, we're right on the heels of Nashville, these other secondary markets that offer better growth stories to investors. And I think COVID's only expanded that. COVID's shown that you don't have to live in the coastal markets to have companies, and companies are coming here, talent's coming here, and that story is just going to continue to grow. But institutions are here.
Excellent. We're getting some very interesting infrastructure as well, right? The new airport and just a number of things that are helping.
You bring people in from outside of Utah and land at the new airport and drive them 10 minutes to my site. Denver doesn't have that. Austin, none of these other markets has that close a proximity to an international airport. The infrastructure we have here is really unique, and people are starting to take notice.
Excellent. Okay, let's see. Barring another COVID type event and a higher interest rate environment, what are the major risks on your projects?
Again, I think it's supply. I think you can get ahead of yourself really quickly if you're not really careful in your capitalization and how you structure. And how we've done it is by going lower leverage and even unlevered on certain projects, so that we are playing and compensating ourselves on multiple versus IRR. And so that time we can afford to be more patient and aligning with the investors who believe in that same needs.
Super. Tell us a little bit, are you doing anything outside opportunity, kind of non-opportunity zone? You were in traditional private equity real estate, and then you're now pretty heavily in opportunity zones. Have you abandoned that, or are you still doing something?
I started, I ran our industrial portfolio for 7 years, and here at BYU, I teach an industrial class. So industrial is really kind of the asset class I know the best. And I always viewed these opportunity zones as, you're buying old infill industrial and, developing. I wasn't a developer at the private equity shop. We invested in developments, but I wasn't developing. So once we got a few of these projects going, it was like, okay, you're making these 10-year bets, and someone always, diversification strategy. I'm like, okay, I need some singles and doubles. Where else can I do it? And so I started looking at in just regular value add industrial. And actually I was fortunate. I was teaching class right when COVID hit at BYU on industrial. I think it was the first week that they'd taken everybody onto Zoom. Classes were shut down. I talked for an hour and a half to a black screen. Nobody asked any questions. It was just, the echo of my own voice. But one student asked one question, is how industrial is going to do in COVID. And, I'm sitting in my home office, and I was like, hadn't thought about it because I was more worried about these apartments I just launched, this office I just opened with with no leasing in it. And, back then you just thought my 80-year-old neighbor's ordering his toilet paper on Amazon. Supply chains are broken down, onshore is going to happen. All the dynamics that we've seen play out kind of triggered just because of the experience I had with industrial. So literally hung up the phone and called up the broker contacts that I had in the market and said, people are going to be panicked. People who are non-industrial folks who've gotten into it, because pre-COVID, it was still a real kind of growing hot sector. So we got to buy everything we can. So we were fortunate enough to be able to buy about 200 acres of land out by the airport. Myself with a partner built about 2.5 million square feet of industrial. We've sold 2 million square feet of that industrial to institutional capital. And we've got a few remnants there. So that which was, supposed to be singles and doubles, we timed right, and it did really well. And that's afforded, I think, me to be able to grow BCG and be able to focus on some more of these impact pieces. And we also launched, and so we've got BCG Industrial, which is, another kind of vein of what we're doing. And we're chasing, another 700-acre parcel right now with the state. And we've launched BCG ARC, which is affordable residential communities. We've brought on some support for that, and we've successfully gotten 4 awards for light tech credits to be able to build affordable units. So we're hoping to get that to 400 to 500 units a year be able to expand that. So we have diversified. We are buying some non-op zone pieces. So outside the 45 acres, we are doing more. We've raised probably 600 million of equity since we started. 400 million was really for op zones. The other 200 million has been kind of a third's been in other projects.
Excellent. Here's a question. Do investors get similar tax benefits if they invest in businesses that are located in opportunity zones?
Absolutely. If they need to be structured as qualified opportunity zone businesses, the legislation actually, when I first read it, because I had some venture capital background, real estate's low hanging fruit. Getting tax-free on a 2 to 3 multiple is really nice on real estate returns. For venture capital, private equity, if you can take that same tax appreciation benefit on a 5x, 10x, 30x type investment, it's going to be a game changer. Unfortunately, you haven't seen a lot of traction with those businesses doing that because one, venture capital has some different mechanisms to it. And a lot of the funds coming into private equity are pension funds or endowments or otherwise non-taxable entities that just, they're not able to take the benefit of it. Benefit really has found its way to more of the high net worth families. And it's a little bit more spotty with that, but I'm a huge fan. Every business I talk to, I was just talking to one on the way down here. I make sure they're aware of it. I say, we'll put you in touch. We'll show you how to do it because it's an underserved part of that legislation that businesses should be trying to take more advantage of. And hopefully they will.
Great. Excellent. Let's see. Now that Granary District land pricing has increased so much, where do you think are the next areas in Salt Lake that will see investment?
Where I'm buying. No, Salt Lake continues to be a growing market. I mean, we're buying and assembling some land just a little bit outside that realm. I think any of these old infill industrial areas are great. South Salt Lake, 17 South, 21st South, that growth path is just continue, I think, to grow. Density is going to be coming. Hopefully it's done responsibly. Those are really within that kind of pocket are there. But I won't say more than that.
Okay. Understand.
We've got a few more pieces that we're putting together.
That's great. Here's a new question. What do you think happens to development in Salt Lake City when the opportunity zones expire at the end of 2028?
It's a great question. And probably I'd point out that we did our first investment in the opportunity zone area before there was opportunity zone legislation. I mean, these real estate deals need to make sense in and of themselves. Right. We always, while we show investors the benefit of opportunity zones, we still underwrite to kind of standard underwriting standards. If the deal wouldn't pencil without the opportunity zone benefit, then we don't pursue it. The opportunity zone just lets people come in and probably believe a little bit earlier, take a little bit more risk and go a little bit larger scale and create some alignment. Yeah. But we don't ever show investors return after tax with the op zone benefit. That really goes down to them as an investor. We'll meet all the qualifications, but the deals still need to make sense in and of themselves. Otherwise, if you do a deal purely for tax reasons, I've never seen it work out.
So you're still bullish.
I'm still bullish. Yeah.
Here's one. What are your views on the infrastructure support in Salt Lake City area? For example, water supply.
Well, that was a much bigger concern probably 9 months ago than it is now. Too much water supply is coming. It's a bit cyclical. The infrastructure in Salt Lake City is lacking, especially in the Granary District. We are working really closely with the city on establishment of HTRZ zones, which will allow some of the tax increment we're creating to be reinvested in the infrastructure. So really, we're negotiating with them now where 40% of the dollars tax increment created within these zones will go back into the infrastructure outside of curb, was what we call it, outside of our developments. And then 60% can only be given back to developers for real, true public good within curb type of development. So hopefully that will give the funding necessary to help improve some of the infrastructure, roadways and the like that the city needs, because they're always torn between way too many needs, too many projects and not enough funds. This hopefully we're helping them through state legislature and mechanisms kind of channel the funds in the right areas for us. But water needs, infrastructure, air quality are issues that we've got to be concerned about. That's why I think it's so important to really be as forward thinking as possible in sustainability.
Excellent. Okay. What are you seeing in the construction marketplace? Are things slowing down?
starting now to see pricing come down a little bit. That said, it was up 40% from, 12 months ago. Now it's only up 38% from 12 months ago. So don't want to get too encouraged by, a pullback there. It's going to be really interesting. The more and more we hear, there's a lot of projects that are not moving forward because of financing.
Yeah.
The financing is going to make it a lot tougher for groups to be able to push forward. And so you'll see more and more deals drop off. They just haven't yet in mass. And so it just hasn't caught up. I think there's going to be a lag. So you probably won't see that benefit of pricing for, probably another 12, 14 months. But that again, is probably more labor. You still got supply issues. You're still building out of a backlog, and pricing tends to be sticky. We're not underwriting or counting on prices coming down really significantly at all.
Okay, super. Tell us a little bit about just as we kind of approach the end here, just a little bit about stepping out on your own. We've got probably on the people on the call that they're working for a firm and maybe they've wanted to scratch this itch like you did, and they've wondered, hey, when do I do it? What caused you to make that decision to start your own company?
Probably the scariest thing I've ever done. It is not something to take lighthearted. I was, had pretty successful private equity career, but I knew the next 10 years were going to look like the last 10 years, and kind of felt, kind of hitting a wall there a bit, and just personal frustration on I needed something else. I will say, and I could probably say this in this environment with these people watching versus most other places. Honestly, it was a lot of prayer and fasting. And to get real personal, I was thinking a lot about doing it and getting the courage up to do it, and just not sure what I was going to do. Just felt in that kind of decision fog. And it was right around tithing time, and for the first time I was debating, and I'm not preaching which way to go. I've always paid on gross. I was thinking, gosh, if I'm going to leave, maybe I pay on net. Bishop came over, were talking to us, and said, hey, windows of heaven, brother. And I clicked and sent in on my gross, and within 2-3 hours, I got 4 different phone calls from people offering me to come work with them, come do jobs with them. A few of them back here in Utah. Never did anything with them, but it was just a confirmation that I was making the right decision, that I did have value outside of my current employment, that I was going to be okay, that the Lord was watching out for us. And so we literally quit the job, not even deciding to come back to Utah. That was a separate decision a few months later. And so then came back and just kind of turned it over to the Lord and said, I'm willing to work. If I'm flipping burgers, provide for the family, I'll do that. And feel fortunate that he's put enough in our pathway, and feel the responsibility to provide and do the affordability and do the neighborhood changing and doing these impact oriented things, because all of this is it's just blessings.
Yeah. Wonderful. What a great story. Well, we're out of time. Brendan, this has been absolutely fabulous. Thank you so much. Let's end with, we have students on the call, and they are getting ready to start finals tomorrow. And a lot of them will be entering the workforce. If you were to share a nugget of wisdom or two, if you were one of those young persons sitting prepared and ready to face the world, share a nugget of wisdom that you would like someone to convey to you that as they get started in their career.
I would say, and we talked a little bit about this yesterday in the real estate class, 2 things. One, your reputation is everything. Your reputation will carry you through the rest of your career. So guard that ferociously. Do not ever bleed that line. Do not ever think that doesn't matter, that you can skip by, or do anything that would tarnish your reputation at all. There's no amount of money, there's no amount of time, there's no amount of position that garnishing your reputation will ever pay off in the long run. Second of all, a lot of people come and want to talk to me, want to talk to my friends and my peer group. And that's nice. It's good to look for people who are ahead of you and model after that, but pay attention to your peer group. It's my peer group that I came out of BYU with, that I came out of Harvard with. Those are the guys who I'm interacting with now. Those are the guys who are funding my deals now. Those are guys I'm serving on boards with now. It's that peer group that you grow up in the industry with that really is going to make the difference in your career and the difference in your quality of life, and hold you to a standard that they do as well. So, sounds maybe a little Sunday school answer, but pick the right friends, value those friendships, value that peer network. Don't ever put yourself above any one of them. and try to lift each and every one of them as much as you possibly can, because there will come a time where you'll be falling back and they'll be the ones lifting you.
Excellent. Well, thank you so much.
You're welcome.
for
I
taking
appreciate it. Thank you.
Time to come down to here and share with us. It's been wonderful. And to all of you who are on the call with us, thank you for joining us. Hope you have a wonderful day. This was our last webinar for the academic year. So we'll take a summer break and we'll be back in the fall with a new lineup. So be safe out there. Hope you have a wonderful summer and we'll see you in the fall. Take care. Thanks again.